drag along trailer things for small.
A weekend weekend Centre Parks is definitely harder work than 5 days in the Pyrenees. I can tell you.
Yay! Oh dear.
Yeah, it'll be fun.
No, we'll be fun. Looking forward to it.
Good for you.
Lads, then should we crack on?
Yep.
Yeah.
As Thin Lizzy once sang, the boys are back in town.
Was it Thin Lizzy?
I think it was. Apologies to Thin Lizzy if it wasn't. Welcome everyone, episode 7, Taking Stock After the Bell. I'm David Henry, joined by James Hughes, Investment Manager, and Mr. Jonathan Raymond, Investment Manager. Earnings season. We've been talking for a while about an earnings recession and this slow-moving train of a recession coming down the tracks. It just hasn't arrived. Per Refinitiv, so far 77% of S&P 500 companies that have reported have either beaten expectations on earnings, and 74% have beaten on revenue. Any thoughts?
You normally get a majority of companies beat, but that beat rate is a little bit higher than normal.
Because management manage expectations in advance.
Human nature, right?
It's amazing how well margins are holding up still. I mean, that's the thing, because I think, we've discussed it a lot. I think at this stage companies can pass on revenue increases because of inflationary pressures, but obviously it's being able to maintain margins is quite a different story. And of course, there are cost pressures at the bottom, whether it's increasing salaries or energy prices being passed on. But I think based on where sell-side analysts and a lot of strategists thought earnings were coming in and where the consumer was, it's it's always the next quarter we're going to see a slowdown again. Next quarter, it's just not happening.
I think it's that. It feels like a slow-moving train, but it actually just hasn't. The point on margins, I mean, if you're looking for a reason, one of the reasons that you can be negative is that margins are, if not quite at all-time highs, they're pretty darn close. The impressive element for that, and we mentioned this with James last time, is the revenue. You're beating on revenue. You can cut cost and protect earnings, but the revenues seem to be rolling in. Now, an element of that will be pricing with inflation, but it seems to be okay for the time being.
It does. But a lot of management commentary in conference calls was quite reasonably cautious. But again, this comes back to human nature. This comes back to the management be cautious and guide down, and then they end up beating the numbers. That's the kind of game that they all play. But obviously, in some quarters, that game is played more than in other quarters. If that makes sense. And I'm not sure if we come on to it, but Home Depot yesterday, the day before, numbers were weak, and management were, we don't know where this is going. Obviously, Home Depot.
But they don't, and I thought the interesting part of the Home Depot numbers, which I had a look at myself this morning, it's the big ticket stuff where you're seeing the sogginess.
Yeah.
But if you were, going to buy a barbecue, you would have done it 2 years ago.
Exactly.
Like, how often do you need to buy a new barbecue?
We have to be really careful when we're thinking about both the economy from a macro perspective and corporate earnings, is that we're still in the end of the bullwhip effect, for want of a phrase, i.e. we bought loads of stuff during the pandemic because we couldn't go out anywhere. Now we're not buying as much stuff, so manufacturing is effectively in recession, and stocks like Home Depot are getting hit, whereas the airlines and leisure stocks and London restaurants are still absolutely booming. Now at some point that comes to an end as well. But again, when these things come to an end, it looks like a recession, but it might actually just be normalisation, and we don't know where the normalisation is. We don't know if it means a Home Depot's sales 10% structurally higher than they need to be, or if you take a sort of pre-2020 trend, where are we versus that trend? Should they be higher or not? So there's lots of moving parts. It's very difficult to disentangle.
It's very difficult for sell-side analysts, isn't it, and buy-side analysts as well. But talking to our guys, it is what is that normalised level of demand, and what's the normalised level of manufacturing across different industries. But again, we had JD Sports this morning. Everything looked pretty reasonable. Pretty good. Statement was slightly cautious, as you'd expect. Exactly what you just said. Again, Experian was, pretty in line. Again, the stock sold off a little bit because of a softer statement. So that's the recurring theme, isn't it? You've actually, the numbers are in line with what the market expects. It's just the outlook statements are still slightly cautious.
Yeah,
but
yeah.
to be honest, if you had a CEO at this stage saying, actually, we're super excited about the next quarter and next 6 months, next 9 months, everyone would go, that's a very odd statement.
Yeah.
So they can't
There's
anything.
there's no upside for management to be bullish at this stage, because everybody seems to think we're going into a recession, and we've talked about it ad nauseum. So if we do go into a recession, it will be one of the most telegraphed recessions in history. So if you're a chief exec and a finance director and you're talking a bullish game now and you get it wrong, you are done.
You are done.
So it's human nature. It comes back to this kind of expectations game a bit. But I totally agree with James. Things seem okay, but bit of cautious guidance.
Yeah, 100%.
Nothing's falling off a cliff. Just
But again, we should probably make it clear for people listening to this that I guess the stocks we're looking at are the very big quality names, and there is an element of corporate Darwinism when things get more difficult anyway, that some of the names we invest in will take market share. So yes, revenues will grow, but they're just taking market share of where they're operating.
Yeah.
So we are looking towards the larger quality end. You have had some bigger wobbles in small and mid cap,
and cyclicals.
Yeah, and I think we've talked about this as well in terms of there's a lot of value around in small and mid caps. Some names have sold off, I think, much further than they should have done because a competitor in the same space has had more numbers. Obviously, they're far more fragile businesses than the larger names we look at. But certainly in our space, it seems, I think, where we were this time last year, we had almost expected the recession to be, we're probably almost saying we'd be majority through the recession. We hadn't even started. If there is going to be.
I'm surprised by that on an almost daily basis, but these things are slow moving, and we've got used to economic cycles that are very, very fast. Maybe it's a recency bias, and we expect something a bit quicker, but it certainly feels a bit slower. Just on the expectations management, I think it's interesting here, the first chart that we're looking at, which is analyst revisions, that actually those have started to tick up now again as a whole. Now there is, as you would expect, discrepancy by sector there, as we can see. I mean, analysts, it's a tough old job, right? But probably a little bit behind the curve most of the time.
Normally, yeah. And I think if you ask most decent analysts, they'd probably agree that what their estimate for this year's earnings probably doesn't make a massive difference to what their thesis is on a stock, for instance. So these are useful aggregate numbers to see where people expect earnings to be. But it's interesting that we've gone through a whole kind of 12 to 15 month period where revisions have been negative, i.e. analysts have been reducing their forecast for earnings, and it's just turned positive. Generally speaking, markets go through difficult times when revisions are negative, and markets tend to do quite well when revisions are positive. So it's kind of bullish in a way, but we've still not, from a headline level, we've not seen a massive downgrade to earnings. I.e., if we get a recession, a normal recession, there is no such thing as normal recession, but something that doesn't look like 2008, for instance, then earnings ultimately will come down. It's just a case of by how much. So whether it's 10% or 20% or 30%. So if we still get that outcome, then earnings are too high. For sure.
Nothing tests an investment thesis like a recession, and we're about to find out. I think we're about to find out which companies actually have pricing power.
Yep, totally.
I don't know. It's I know the UK is a small part of the world in terms of global index or indices, but the Bank of England just got it completely wrong on GDP growth, and it's if you look at that, there might not be a UK recession.
Is there? So do we need them to make a projection on GDP?
I'm going to stick up for the Bank of England. So
for the first time ever.
So in October last year, post the Kwarteng budget, they came out and said GDP growth is going to be negative and we're going to have a really bad recession lasting 5 quarters.
Yeah.
And they were totally wrong. Now, how did they come up with that estimate in the first place, or that forecast in the first place? It was because at the time, UK natural gas prices were 4 times higher than they are today. 4 times higher. Since they made that forecast, natural gas prices have fallen by 75%. So you take that into consideration when looking at households and businesses' budgets, and you get from -2% GDP to +1%, and it's really not rocket science. Now, it's not the Bank of England's job to forecast where they think that natural gas prices go. If you look at a chart in October of natural gas prices, you would probably have thought, well, it spiked post-Ukraine with some problems over the summer, it spiked again in September and it was coming back down. It's likely that gas prices will come down. But the Bank of England can't assume that gas prices are going to fall. That's not their job. Their job is to take the price
as it is
and use that for their forecast. So before all the so-called we're sick and tired of experts brigade come out in force, it was entirely plausible that that's what the Bank of England's forecast was at that moment in time. And because things change, when the facts change, I change my mind, they've changed their mind.
But the facts did change some time ago. They're very late to the party in terms of...
Yeah, they only update their forecasts every quarter or every inflation report.
But then, going back to Dave's point, do they need to make GDP forecasts?
I think the fewer things they're asked to forecast, the better.
Oh, well, generally, yes, because...
Generally, I think we're quite bad at
and this comes back to earnings estimates, isn't it? It's all little bit kind of pointless, but we all need to have some sort of kind of yardstick as to where we think we might be going, and then work around that on a sort of scenario.
Yeah, that's
basis.
true. Yeah,
that's my view.
That's fair.
Just because we're on the Bank of England, we'll stick with it. Natural gas, it's a point I wanted to make as well. We are, as a country, quite exposed to higher gas prices because we have more gas boilers in the average home.
Yep.
And we have to import it primarily from our friends in Europe, I think. That is now starting to come out of the numbers. So when you look at this inflation trends, so blue line is goods inflation, green line is services inflation, and orange is the headline. You'd expect, well, the estimation is that orange line and the goods inflation is going to come down really, really quickly, not least because of the natural gas coming out of it. Other than imports, it seems it's been more difficult to get rid of inflation in the UK than elsewhere in the world. Do we have any thoughts on why that is the case?
Yeah, I mean, you touched on the point about how we've been billed for our energy over the last 12-18 months. That has had a material impact on the headline CPI figure, which begins to drop out from next month because July, I think, is another kind of staging post in the energy price guarantee or the energy price, what's it called? I can't remember what it's called. The way we set our energy bills.
Tariff, isn't it?
The tariff, yeah. So that's dropping out again in July and again in September. So you get these kind of big step changes. That's part of the reason, but I also think I don't know actually. Gas prices is the only thing that I can think would be different between us and
I mean,
Europe.
I would have thought there's an element of currency playing into it. I know sterling has strengthened quite a lot recently, but we're a massive importer, aren't we? I'm sure.
Currency, and we've had a lot of people leave.
Yeah, we've imported a lot of currency over that period. You know, we went for our parity against the dollar, weren't we? So that would have had a big element, a big impact initially. And again, as you say, migration.
We have to import resources, and we've exported a lot of working age people. It's just a fact. So, we have. I think during COVID, maybe it's demographics in the UK. I don't know, to be honest with you, but there feels like there was a lot of people that dropped out of the workforce.
Yes. So there was some labour market data yesterday. The proportion
not great, was it?
No, it was okay. So the good news is that the proportion of 16 to 64-year-olds, i.e. prime age employment, the proportion of that population who are working has gone up, and the proportion who are inactive has come down. Now, people who are inactive are either sick or students is the second biggest category of people in that and because of COVID, the number of students has gone up because people have now re-enrolled to university when they wouldn't have done during the pandemic. But also we've got a long-term chronic sickness problem in the UK. Some of it can be attributed to long COVID. Part of it can be attributed to the fact that the NHS is struggling to treat people and get people through the system post-pandemic. So we have a particular sickness problem in the UK, and that came out of the data yesterday, albeit those numbers are falling at a reasonable pace. So we are beginning to see a normalisation, but it just takes time. So if you look at, every country, so both the Euro area, the US and the UK, the three of them have all got labour market shortages, but for different reasons. And the UK's reasons is too many people economically inactive because of sick. And that's different to what it is in the US.
Yeah, there's a bunch of idiosyncrasies. I mean, this chart shows you the Bank of England want this chart down, don't they? Down. Basically, we need to see some softness in the job market. This was, I think, an interesting one. So this is CPI, but annualising the 3-month figure.
Okay. Yeah.
So we've seen more of a drawdown there, and that suggests we're sitting around 6% now. That's a little bit stale now, but I think consensus is for inflation to come down pretty quickly in the UK, and if it doesn't, then perhaps the BOE are in a wee bit of a bind. We mentioned price and power. Let's touch on this. Apple is an absolute monster. Reported last week. Market cap that's John bigger than the entire UK market.
So Apple is now worth more than the entire UK stock market, and it's worth about £2.17 billion, as the red line here for Apple shows, versus the blue line is Apple, and the red line is the UK, and you can see that Apple 10 years ago was worth about £300 billion, so it's gone up by a factor of 7 or 8 in the last 10 years, and the UK market has gone up by 10% probably, 15% maybe in that time. So Apple is also worth more than the Russell 2000, which is an index of 2,000 US smaller companies, and is also bigger than the entire Toronto Stock Exchange, I found out this morning. So
Google things that Apple is bigger than.
It's great.
Best company ever.
Well, Microsoft isn't far behind, so I think Microsoft is pretty close to these numbers as well. Because they're dominant, and as Warren Buffett once said, if you are offered $10,000 never to use an Apple product again, would you take it? And for a lot of people, they would probably say no. I will stick with my Apple products.
Yeah.
So you talk about moats, and you talk about brand, and you talk about intangible value. It's probably got the most.
I think AirPods are the best consumer purchase I've ever made.
I've not had my AirPods for a week, and I feel totally lost. Completely lost.
They're just, this is going to sound ridiculous, they just really work.
It's funny because when I first saw them, and it was people getting on the train, typically at Clapham, I think. Where do you live, Dave?
Sorry, mate.
But I saw you see people with these little white pods in their ears, and I just thought this is ridiculous. Why would I want them? I'll lose them.
It's James, the middle-aged man.
I know. Wow. I saw a great meme the other day, Suburban Dad, and it is.
That's a vibe, isn't it?
So bad. It's so, I looked at this meme of this guy, zip up Chile, and probably much like what we're today. Trendy trainers, chinos, AirPods, and I was like, oh my god, it's Jonathan Raymond.
Thanks very much.
Suburban Dad.
Apple totally dominant. Things exist today that are dominant in our lives that didn't exist only 20 years ago. So I'm sort of never say never. It's difficult to see how Apple becomes less dominant.
But it always is. Like Nifty 50 era, you could, what was Nifty 50 stocks? I mean, the one that people always pull out is Kodak, which obviously got innovated away.
Coca-Cola was in the
Coke's
Nifty
still
50.
around.
IBM is still around, albeit with a shadow of its former self.
Coke and Apple, two Buffett stocks.
Yeah.
Coke isn't. Coke is still
around.
Procter & Gamble.
Yeah.
It's difficult to see what. I mean, they're just so innovative, aren't they? I've got my contracts coming up for renewal, and you can look at the Google phone, or I guess a Samsung or whatever else, or it's just Apple, the iPhone, which is what you use. It syncs with all your devices, and
it's already in there.
Am I going to change and use another mobile phone? Probably not.
They just they look really good, and they work, and absolutely, what a beast. This is a story that rolls around every once in a while. US debt ceiling. So the 1 year CDS, which is a credit default swap, which is the cost of insuring against a default from the US government, is now very, very high indeed relative to recent history. There was other spikes that you can see there. 2009 global financial crisis, obviously. 2011, 2012, 2014. I think, and maybe I'm misremembering, but I'm pretty sure those were the last times that the debt ceiling issue was on the table. Is this something to be worried about? No.
No. I don't see what. I mean, this looks ridiculous to me. I mean, you compare it to 2009, when there was a genuine financial crisis and genuine concerns over the viability of the financial system, and you compare to where the CDS spread is today, and it just looks completely out of sync. But I know my man on the left.
It's deeply unlikely that the politicians will let the US get to the stage of technical default. So the CDS chart here is obviously very high. Dave's absolutely right. It's the cost of insuring against default, not the probability of default.
That's a very important
distinction. So it's a bit like insurance. We all take out insurance for our house because just in case. We don't just because we pay a couple hundred quid a year for it doesn't actually mean we think that that's the probability of our house burning down. And it's the same thing. Now the problem is not necessarily with default per se. The problem is with the shutdown process. So if you think of a business or a household bank account, it has some money in it, and it has outgoings and it has incomings. So if the US government is running a deficit, which means that its outgoings are higher than its revenues. So if the government can't raise the balance via issuing debt, which is what they're doing at the moment, then their bank account diminishes as the outflows continue until they got nothing left. So basically the US Treasury account, and it's called the the Treasury General account, I think it's called literally, will start to run out at some point end of May, end of June. But obviously the Treasury Secretary Yellen has got options, i.e. she can stop paying people, she can lay people off, she can cut contracts. So there is like the worry and the risk is that it gets so close to the actual default date that she has to enact special measures on reducing spending, which basically means not paying staff. And if you think of the UK, what is it? Probably 25% of US employment is public in some sort of way.
I think it's more. I think it's like 40%. I think.
So those people don't get paid. And that's basically what it means as the cash runs out.
Did we have this before? Wasn't there a delay in teachers and nurses being paid in the US? A couple of weeks or something, wasn't it?
The debt ceiling has been raised, extended, or revised 78 times since 1960.
Well, I mean, the obvious thing is, why don't they just abolish it?
I mean, if the whole thing is pointless. I've been getting calls on it though, because it is something that rears its head. It feels like every couple of years, and you never want to sound like complacent, of course, but I don't think anybody has any real interest in seeing the world burn necessarily. We've been down this road before, and we've come out the other side plenty of times. There is a playbook here, but you can never discount the possibility, I suppose. The other thing I think it's worth mentioning as well, I mean, because of rates going up, the US is now spending more on servicing debt annually than their entire defence budget.
Yeah.
Rates are coming down. Well, we're incentivised to get rates down. If inflation gets under control, then they're going to cut.
Yeah. Well, if US debt default or worries of debt default cause a slowing in the macro economy because people don't get paid and contracts get postponed, on top of the pressures that we've already talked about in the economy, and you have something resembling a recession, then both inflation comes down and rates come down. So the deficit widens because that's what happens when you get a recession. Your spending goes up and your receipts go down. But in a way, for the US government, you're absolutely right, Dave. All the US debt, the term structure, which is a very fancy name of saying the duration of US debt is very short dated. It's very so most of the bonds in issue are short dated US issues. A lot
Why
of
is
debt.
That?
It's just the way they've always done it. Total opposite in the UK. UK's got a relatively long debt maturity, which is both good and bad. But that's all the way they've done it. Despite there being quite a lot of demand for 10 and 30-year bonds in the US, they don't seem to issue a lot. There seems to be one bills, short-dated bills.
Why didn't they
3
issue
to 5
a bunch
years?
of long-dated debt like 3 years ago? I mean, I'm obviously too thick to contribute, but like that to me would seem like just a total no-brainer.
Well, it looks like a no-brainer now, doesn't it?
Well, it does a bit, but hindsight's 20/20, I guess.
But you're right.
Rates are literally zero. I mean, Buffett didn't Berkshire borrow $1 billion at 0%?
Something stupid.
I think in like March 20, April 24, or early April 20. Remember that?
Well, it's akin to Husey doing his mortgage 18 months ago on a 1% 5-year fixed rate.
The man's timing is impeccable.
Just asked him.
Just on housing, I picked this
Special
up.
advisor.
just on housing while we're on it. This caught my eye. So the UK rental market, it's now on average £1,000 a month to rent on average outside of London. That excludes London. Rental costs are up 25% on average from the beginning of the pandemic, according to Hamptons. There's a bunch of reasons for this, but not least rising costs for landlords, as we've discussed before. Interest rates going up, less favourable tax treatment. It's not a great time to be a renter, as the executive.
It's not a great time to be a landlord either, because
I was about to say the same thing, which means that something's not right. No. The market is
system's not working for either party.
Nope.
You've got these energy certificates coming in, haven't you? Where there's a change in.
Well, I haven't even mentioned that.
No, I mean there's a change in law where everything's going to have to be updated. It's costing landlords a lot of money, either on repairs or just certificates that need to be put together. As you say,
we hear this from clients a lot. They've all got to spend some money to get their energy efficiency up to, is it C or B rating on the EPC thing?
That was another thing about reliance on outside resources and inflation in the UK as well. The average home in Europe is much better insulated than the UK. I live in a Victorian building. Pretty drafty.
Yeah.
Like I'm sure a lot of us are exactly the same.
Duct tape over the open fire still.
My track record with DIY is pretty appalling, mate. So I just get people to sort that out, please. But it doesn't seem to be working. And we had Michael Gove yesterday, I think, announced the government renters reform bill. There's some safeguards in there for tenants, which are really important. But for landlords, I guess that probably makes the whole thing even less appealing, I guess.
Well, the Michael Gove thing's interesting because he's Secretary of State for departments. Anyway, he covers housing. So, as we've just discussed, the market's broken because we haven't discussed it, but because basically there's a shortage of properties all around for both buyers and for renters. And so, as one of his own MPs commented on Twitter, if only Michael Gove knew someone who could do something about this, with the implication that it's in his brief to get house building going, and it starts with the planning rules, and that's not everyone's cup of tea. I live in and around near Wokingham, which looks like a giant building site, and you sort of drive around and you think, what's going on here? But still, we are structurally shorter houses. But as soon as there's a planning application in your local village or your local town, the whole town rally around and are up in arms, and that's what happens. That's self-preservation. That's natural human behaviour. So we can't judge that. But something needs to change.
It does. I mean, James and I discussed it last time, but I'm interested in your thoughts. 100% mortgages. Thoughts?
We've played that game before, haven't we? I don't think that's the answer.
And it's probably not the answer. No. But it's an answer. In the very short term, for a very small cohort of people, and it's probably a better answer than Help to Buy has been for many people over the last 5 years.
Yeah, why do you think that?
Because we've probably not seen the growth in equity in the last. It's not fair. I don't know enough about it, but there is a very small subsection of people who 100% mortgage might work for.
Yeah, just generally, as I said last time, I don't hate the idea. But as ever, there's probably knock-on unintended consequences. And James's point was, credit supply actually probably drives up the cost of houses. But given it's just one building society Skipton at the minute, I think probably the impact in the near term is pretty limited.
I mean, the overall answer is the answer for lots is just more affordable rents. But again, that's a policy decision. And is the answer you make it more favourable for landlords again to own? Do you have it wasn't that long ago where you could offset the financing cost of your mortgage against the rent coming in. I think arguably that arguably that keeps rents low. I think every conversation every renter's going to have with their landlord is not about rental costs going downwards. It's how much is it going up by. Ultimately not everyone, but I think the large majority have had some sort of pay rise, or will be receiving some sort of pay rise because of inflation, and landlords just push it on, don't they? So and to be honest, because it's so unattractive to be a landlord, I don't blame them for doing it. But over £1,000 a month in rent is a lot of money.
Outside of London.
Outside of London, exactly.
Yeah. Where did you first move? Where did you first rent when you were down in London?
In Stockwell.
Were you?
Yeah, with a friend.
From me.
Yeah, exactly.
What about you, JR?
Well, I was actually told, it's a funny story actually, one of my closest friends, and he told me he bought a flat in Clapham, and when I turned up it was definitely not Clapham, it was definitely Stockwell. At the end of the very long road, I think it was Clapham Old Town, but it was about a mile away.
Clapham rent, presumably, as well.
Of course. He's a banker, so.
Yeah, absolutely. That's a good man.
I was in Clapham Junction, right by the station, above the party shop on the second floor.
Great
Party balloon shop.
I have spent a lot of money in
Classic.
that party balloon shop.
Well,
Yeah.
Not a
I've done the
brag.
same way. I moved out 3 months before the 2011 riots, which took place in and around the junction.
That's right.
Yeah, so I was living in Stockwell at the time.
Yeah, good times.
Yeah. There we are. Where was your first place?
Beside Infernos. So yeah.
Brilliant.
So final thing. Let's move on. Final thing. I thought this was really neat. AQR have put out a paper on diversification, which I came across from Meb Faber's Idea Farm newsletter, which I would really recommend if that is your bag. There's a couple of great quotes in here, just when you're thinking about diversification. A diversified portfolio that you hold today might look completely sensible. Tomorrow it will look full of mistakes. After the fact, that portfolio will almost always have lots of positions that have underperformed. I think this is an underrated aspect of portfolio management that clients don't necessarily get.
Yeah. I think if clients saw just the end figure of a portfolio and the performance associated with it versus benchmark, I think it would be a lot easier. I'm often quite jealous of fund managers that just have a unit price, because within our portfolios you can obviously see every single line, and I think it's just natural for most clients to look at what's gone wrong or the negatives in the portfolio and to focus on that and to think, and the comment is often received, well, why don't we sell the losers? And that's not a bad comment to make, because there's lots of good way of running a portfolio of equities is to cut the bad companies that aren't doing what they should be, or I think the quote is, you wouldn't go in your nice rose garden, you wouldn't cut down the roses and encourage the weeds to grow, but we run our portfolios in quite a different way. There are natural, there are hedges in there, there are different types of fund structures for reasons, but for the portfolio to grow over time, there's always got to be an element that underperforms versus the other part of it that outperforms. I'm not sure I've explained that very well, but
there's just two ways of looking at it, right? Because there is some academic evidence that suggests that momentum wins. What does that mean? I.e., the things that are doing well today do well tomorrow,
Doing well, yeah.
and the things that are losing today lose tomorrow. And that would argue for a strategy of selling your losers and buying more of your winners.
Yeah.
However, there is occasionally some pretty savage mean reversion, and we're talking about growth versus value a lot here, and we might have a late addition to the chart pack which I've just pulled up, but if you look at a chart of Amazon against Shell from the 1st of January 2020, pre-COVID, by the end of 2020 Shell was down 60% and Amazon had doubled, up 100%, and if you go through the 2021 period, Amazon's still flying high and Shell starts to recover, and if you look to today, in the last 12 to 15 months, Shell has clawed back all those losses and Amazon has halved again. So today they stand at exactly the same place as they stood pre-pandemic.
That's unbelievable.
And that comes back to, would argue that if you owned just Amazon during the pandemic, you'd have been doing great and you didn't want to buy any Shell. And today it's the polar opposite. So there is an element of mean reversion. And that's why we have to carry on owning things that aren't always doing well today, because tomorrow might look different. And often does.
Undoubtedly. Diversification isn't perfect, because it always means you're going to have to sit in front of a client and the eye is drawn, as you say, hugely, to the things that maybe haven't done so well. during 2020, why on earth would we hold an oil company, for example? But the alternative is, for the vast majority of people who aren't total psychopaths, pretty hard to live through because you're just putting it all on black. Like Amazon, invested at Amazon at float, and you've held it all that time. You are fabulously wealthy, but you have had to sit through periods where the stock is down 90%.
90%.
Can you do that as the pound amounts get bigger?
No.
As I say, unless you're a robot, I think you'll struggle to do that. And so if that isn't an option for you, putting it all on black, then diversification is a sensible alternative.
Yeah, and eggs and baskets. I mean, I pull this chart up a lot in client meetings to kind of show the madness of the last 3-4 years between the dichotomy between performance of these areas of the market, but also to try and ram home the point that just occasionally we have things that aren't working for us, and whether at the moment that's Asia and emerging markets. Japan has been in the doldrums for years, however it's had a really, really good month or 6 weeks in terms of performance. You're like, where's that coming from? Might just be coming to life because Europe's a classic case. It's one of the best performing markets since October, having been dire for 10 years. So
I mean, this time, not to labour the point, no, we've discussed it, but this time last year, Europe's a basket case. There's a war going on. We're entirely dependent on gas from Russia. Europe is uninvestable. Surprise, surprise, it's the best performing market, one of the best performing markets globally over the last 12 months.
But it goes back to, sort of our investment philosophy of we try to own the best companies within each region and within each sector. And it's very hard to, unless you're a specialist sector fund, whether you're a tech fund or a healthcare fund or whatever else. I mean, in lots of ways it's easier to run those funds because you don't have to make a decision on the macro or on a sector, but it's impossible to choose which sectors are going to perform the best over certain periods of time, and that's why our investment philosophy, as I just said, is to try to own the best stocks in each sector and the best stocks in each region. And if we were that smart at doing it, we'd be running the best hedge fund in the world. But ultimately, it's impossible to do. And over the long term, our investment philosophy does work, and it protects clients. It also takes out volatility as well.
There's two elements. One, get the returns that you need. Two, stay on the journey.
Yeah.
And diversification helps you stay on the journey.
Diversification and discipline are the two words
And discipline's the key one. It's all too easy to look at a portfolio and to look at the scars and think, wouldn't it be lovely to remove those scars? Because it's just human nature.
It is.
That one's done great. Why don't we buy more of that one? Or and that's the conversation we often have with clients. But it's often, as we know, if you're looking at 10 US fund managers, the fund manager that's fourth quartile or first quartile, I'd have a very good bet that most of the time, if you put a year forward, the fourth quartile will suddenly be first or second quartile, and vice versa with the first quartile. It's we have a blend for a reason.
Absolutely. The 3 Ds that every portfolio needs: diversification, discipline, Decra Pharmaceuticals. Not investment advice.
Very good, very good, David.
That was good. You pulled that out your hat, didn't you?
Do you like pets?
You can't let your wee dog die. There's got to put money into it. Right. Just on the diversification thing, I thought this was really salient because you charts are charts and they're lines on a screen, right? But you don't see the emotional pain. This is another quote from the AQR paper. Many people have only a limited capacity to take pain and lack the energy to defend a concept that's underperformed for decades from those two levels up in the organisation. But as a professional investor, this is the job: no pain, no premium. I think I have a really simplistic idea of why the value factor works, and it's behavioural, and it goes through very, very long periods of not working.
I think this is the hardest bit about our job. It's sitting in front of someone and defending something that has consistently not worked despite it looking ridiculously cheap on evaluation, or just a strategy that hasn't worked for a certain amount of time. And it's ultimately, I think lots of people get tired of defending something. It's easier to remove. It's easier to remove that scar. But I think to be a successful investment manager, fund manager in our profession, you have to be able to take that pain and stick to the work you've done and remember the reason you bought it in the first place. It's very different if you bought it for a reason and that reason has changed, or something in the company has changed, or something in the strategy, the fund manager has changed his strategy, then that's different. But ultimately, if the reason or the rationale for owning that is the same now as it was 2 years ago, just because the price hasn't done what you've wanted it to, you don't sell it on that basis.
No. And that comes back to another
bit.
D, dogma. You can't be dogmatic. You have to be, strong views loosely held, I think, is a phrase.
Dogmatist I, pragmatist prosper.
There we go. So, you have to be disciplined, and yes, we have to be diversified, but we definitely can't be dogmatic about things.
No.
And James is absolutely right. It's very difficult.
I think we've got our title for this week's episode. James, thanks very much. That was brilliant. Good to have the gang back.
Oh, it's great. I've missed it.
Yeah, we'll be back in a couple of weeks, folks. Thank you for joining us.
Thanks everyone for listening.
See you in a couple of weeks. In the meantime, as ever, hit me up with any questions. david.henry@cultureachieveit.com. Thank you.